Welcome back to another episode of Investing Explained. Here's today's question. Not everyone has the same experience as John Stockton or some of the other experts on our show, so it's a great question that you bring up. So the answer I have for you might be a little surprising because I think you should hold very few stocks. In your case, perhaps just a handful. So please allow me to provide more context to this. What we typically recommend to new investors is that they buy a market ETF or similar and have hundreds, if not thousands, of stocks in the portfolio. And I think that's a great approach for the vast majority of investors, especially if you're a beginner. But how many stocks should you hold if you want to be an active investor and you're just getting started, which is how I understand your question. So when I say a handful of stocks, I'm not talking about putting in 100% of your portfolio into 5 different stocks with 20% each. No, if you have, say, $100,000 and have never been investing in stocks before, you might be putting in $1,000 into 5 different stocks. Because when you're just starting, there's so many things to learn. First, you have to cope with the emotional pressure of potential losing money. That is why I do not suggest that you put all your money into the market, and even less, I suggest that you do it in just a few picks. You really need to learn how to react when the stock market goes down, and thereby experiencing if stock investing is even something for you in the first place. And another thing is that as you get more experience and you learn more and more about the businesses you invest in, and you might end up with something like John Stockton's 20 or 25 stock picks in your portfolio. Again, I suggest a very different approach as you're getting started, because someone as capable, again, as say John Stockton, might have more than 100 stocks on his watch list, and he's just constantly monitoring how they perform and the current price to the intrinsic value. Now, that is not the situation that you're in. You are perhaps just learning how to value a stock, and the stocks on your radar might be well-known brands like Coca-Cola, Starbucks, or Apple, and they're on your radar more due to the familiarity that you have with the products, more than the analysis that you already made about the company. So what I would suggest is for you to pick 10 or perhaps 20 stocks and put them on your watch list and learn as much about the businesses as you can. And then just pick a few stocks on that list that trades at a good price to value ratio, and then invest very little in them and continue to learn. And I know this might sound a little counterintuitive, but as many experienced investors know, you don't really start learning about a stock before you own it. Or at least you learn about the stock in a different way as soon as you own it. And as you become more experienced as an investor, you can start to add more and more stocks on your watch list, and then you can go from those 5 picks, which is too concentrated, to those 20 or 25 or how many picks that you would have being a more concentrated and experienced active investor.
I don't have too much more to add, but I think it's important for people to understand that if you own both ETFs and stocks in your portfolio, you need to think about the correlation and, more importantly, the variance a little bit differently. A lot of the times you'll hear people say 10 to 15 uncorrelated positions, but that math can change depending on your position sizes and if you're incorporating ETFs or indexes. Let me give you an extreme example. Let's say you had 90% of your portfolio principal in the S&P 500 index, call it SPY, and 10% in an individual company. In this situation, and in general terms, your volatility for the whole portfolio would be similar to owning 10 or 15 individual companies. Now, we can't speak to the correlation of those to the S&P 500 and an individual company, but my point is simply addressing the impact that index funds have on that volatility that you'll see inside of your portfolio. So when you deal with individual stocks, the volatility is extremely high. For example, if you went and looked at Tesla, the volatility on that is just sky high. And if you own 10 companies with extreme volatility, it's going to be an interesting portfolio mix. Most people can't stomach large volatility swings, so you address this by having multiple picks. I don't want to go too far into this comment because I don't want it to add confusion to many of the important concepts that Stig already addressed, but always remember that an ETF will most likely reduce your volatility exposure relative to an individual stock pick. And one of the nice things, I just want to throw this out there, one of the nice things on our TIP Finance tool that we have on our site is every single company and every single ETF, we have the annual volatility for those companies and those ETFs right there on our momentum tool. So people can look at that and kind of get an idea as they're kind of putting a portfolio mix together. So I hope that comment helps you think about it in a little bit different context, because when you are adding ETFs, and I think a lot of people are adding ETFs into their portfolio, that is definitely something that is reducing that volatility relative to an individual company.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.